and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host Pushpendra Mehta. Joining me today is Ben Poole, writer at CTMfile. Ben, I'm delighted to have the opportunity to converse with you again. So a very big thank you to you for taking the time to share your perspectives with us on topics that impact the world of corporate treasury management and beyond.
Thanks, Push. Great to be here.
Awesome. In today's edition, Ben, we shall discuss 4 topics, namely Santander and Iberpay launched the first OCT real payment service, cash prevails while sustainability-linked finance continues to fall in Treasury agenda, US efforts to reshape global supply chains is gathering pace, and finally, Canadian companies are experimenting with AI in financial reporting. Our audience can watch videos on the CTMfile YouTube channel and explore insightful articles, interviews, and industry roundups on CTMfile.com, either by visiting the website or by following the links provided in our show notes. Let's commence today's discussion with our first story, which is about the Spanish banking giant Santander and payment services firm Iberpay launching the first one-leg-out instant credit transfer or OCT Inst scheme. Santander and Iberpay have announced that their respective payment technology platforms have processed the first international instant transfers based on the European Payment Council's or EPC's one-leg-out or OCT Inst scheme, initiated and completed in different currency areas. The OCT or OCT Inst scheme allows payment service providers in the single euro payments area to process instant international transfers from and to countries outside the euro area in just a few seconds. The service is always available regardless of day or time, avoiding differences between time zones worldwide while leveraging existing instant payment standards and systems in Europe based on the EPC's SCT Inst scheme. Ben, you covered this story for CTMfile. Can you, for the benefit of our audience, share how this OCT Inst scheme is likely to benefit corporations operating in the region, particularly when it comes to international payments?
Thanks, Push. It can be a bit of a mouthful, the old OCT Inst scheme. It's not the most helpful acronym to us podcasters, but yeah, basically it's trying to give payment service providers the opportunity to use existing SEPA payment rails for transfers that aren't purely in the SEPA zone. So they can process incoming and outgoing one leg out instant credit transfers through highly automated fund transfer systems available in the Euro leg, and if available via similar systems in the respective non-Euro leg countries or jurisdictions. And also those PSPs in SEPA have the opportunity to offer customers such as corporate treasurers a faster execution of these international payment transactions, hopefully more upfront transparency around the costs and the different parties that might be involved in the payment. You know, often with the cross-border transfers, one of the issues that corporates face is it can almost like go into a black hole. Your payment's left your country or your region or your regulatory zone. It's not arrived at the other bank yet on the other side of the world. We're not really sure what's happened, but as soon as they've got it, we'll let you know. This is trying to give a bit more transparency into that as well, and the ability to trace the payment status. So I think those are all things that corporates have been crying out for a very long time. Worth noting, I think the current maximum amount for one OCT Inst transaction is 100,000 euros. So pretty good, but not suitable for all treasury payments. Treasurers are obviously dealing with some really high value payments. So there's a limit there, but it's a relatively new scheme. It just launched in November last year, and we're actually nearing the end of a 3-month public consultation on the scheme. So any treasurers that want to make their feelings known about the scheme can, I think, head to the European Payments Council website, and there's a link on there. But the consultation window is nearly over. It shuts on the 9th of June, so just a couple of weeks basically away. To get any opinions or comments through to lawmakers and make your voice heard, the next rulebook for the scheme will then be published this November. So it'll be updated after a year of operation and presumably based on comments that they're receiving through the public consultation. So I think this particular story is a nice coup for Spain to have kind of taken the lead here. But also coming up this November, EBA Clearing, for example, will be switching on an OCT Inst service for its RT1 payment system. So there's a lot happening in this space as European regulators and payment service providers try and find ways to connect instant euro transfers beyond SEPA. I know that together with the Clearinghouse and SWIFT, EBA Clearing has also been working on the IXB initiative that we've spoken about before. That aims to enhance cross-border payments in the euro and US dollar currency corridor and potentially additional corridors through the interlinking of and settlement synchronization between instant payment systems. So there's a lot going on, and hopefully for treasurers it's going to answer one of the oldest bugbears around payments, which is cross-border transfers.
Thank you, Ben. You made some great points. Let's shift the discussion to the second topic, which pertains to cash prevailing while sustainability-linked finance continues to fall in the corporate treasury agenda. Optimism is growing among corporates according to the Corporate Debt and Treasury report published by Herbert Smith Freehills and the Association of Corporate Treasurers, or ACT. Research found that a majority of treasurers report a return to business as usual for the year ahead, suggesting that they are increasingly acclimatizing to challenges such as continued high interest rates. The significance of cash and conserving it on a balance sheet for secure business activities was a recurring theme as per the report, with one respondent commencing, "Cash is king," before quantum and tenor were key. Now it is interest rates and management of working capital that are important. The ability to access multiple sources of liquidity was also seen as important for overcoming impediments and managing changing investor policies towards raising debt in the year ahead. The popularity of sustainability-linked finance continues to dwindle, a trend raised in last year's report. Ben, just from a corporate treasury perspective, has sustainability-linked finance lost its appeal because organizations are focused on liquidity and dealing with economic headwinds?
That's a really good question, Push. I think that could certainly be some of the reason here. You know, when it comes to ESG criteria in debt finance, especially sustainability-linked loans, the survey, as you said, highlights that there's a noticeable split in approaches. So companies that are already using sustainability-linked loans seem very likely to continue doing that, but those that aren't, the loans are less of a priority than they were. So many believe that setting up an SLL isn't worth the time or cost, or perhaps doesn't significantly advance their ESG goals. I know that some respondents even questioned if they're outdated now that a company's ESG strategy is a key factor in whether they will get a loan at all, rather than just a small adjustment in loan terms. So there's some good points raised and some good quotes from the respondents in that survey. It's well worth having a read of the whole survey. I wonder if some of the loss of interest or perceived loss of interest in sustainability-linked financing comes from the bad press that it receives in comparison to green, social, blue and sustainability financing. You know, unlike those labelled bonds or loans, the proceeds from a sustainability-linked loan can be used for general corporate purposes. Now, the flexibility of the sustainability-linked structure lets companies from industries not traditionally considered green to access the sustainable finance market and kind of open up a more diverse pool of investors. But I suppose it would also open up questions as to just how helpful that financing then is for sustainability or social causes. So there's a lot of different criteria and naming that goes on in the ESG finance space. I think at the moment SLLs are kind of just out of fashion, out of favour, and particularly when companies want to avoid any possibility of being tarred with a greenwashing brush, maybe that's taken a bit of the sheen off what was quite a popular space a couple of years ago, particularly in Europe.
That's a fascinating and insightful perspective you shared, man. Sustainability-linked finance. Let's move to the third news story today in today's discussion, which is about US efforts to reshape global supply chains, which is gathering pace. US President Joe Biden's sweeping tariff hikes on a range of Chinese imports are just the latest United States moves in a year-long campaign that is rewiring Asian trade routes, figures released in recent days show. Taiwan's booming exports to the US are just one example of the way great power tensions have already reshaped supply chains and how China is getting left out of some of them. The island's sales to US markets climbed more than 80% in April from a year earlier, hitting a record high according to new data. In the first 4 months of 2024, shipments of the US overtook those sent to China, which continued to shrink. This is part of a broader trader overhaul for key American allies in Asia, including major economies such as South Korea and Japan. Both are seeing a bigger share of exports heading to the US at the expense of China. Ben, how do you think this broader trade overhaul and reshaping of global supply chains by the US will impact multinational corporations and their treasury departments?
Well, we've already seen multinational corporations look to shift and diversify their supply chains in Asia, and specifically away from China, and to places like Taiwan, Vietnam, India are some of the popular names that we hear. There's been several drivers for this in the recent past. You know, you think about COVID and the kind of the port lockdowns that China was hit by. So I think for treasurers that are based in the US, this is just another driver in that direction. You know, in his speech, President Biden said that Chinese government subsidies ensure that companies don't have to turn a profit, which gives them an unfair advantage in global trade. I think, you know, he also used the speech to offer support to American workers, but it remains to be seen whether that's maybe just a bit of rhetoric and whether tariff hikes will actually see US firms bringing manufacturing back home, or simply just look to relocate within other Asian countries where perhaps there could be less pressure on wages. I think this is probably an example of how the upcoming US election is going to impact the financial world. In this case, you know, you've probably got Biden and Trump seeming to see who can act the toughest on trade regarding China. But one other point to note is that it isn't just the US that China's having some issues with. We had a report in the industry roundup on CTMfile today on the 21st of May about China potentially being about to target European Union wine exports following the EU's anti-subsidy investigations into Chinese companies. So there's a bit more going on than just US versus China, but I think certainly that rhetoric will ramp up through to early November.
Ben, once again, your viewpoint is a refreshing addition to the ongoing discussion on reevaluating supply chains and diversifying sourcing options. Next up, let's delve into the fourth story, which is about Canadian companies experimenting with artificial intelligence or AI in financial reporting. Canadian companies believe AI will enhance their financial reporting, according to a KPMG in Canada survey. In fact, 87% of companies are already piloting or using AI in their reporting, compared to 72% globally. While more Canadian organizations are exploring the potential of AI, regulatory compliance, skill gaps, and data security concerns have the majority still in the pilot stage, with only 14% using it selectively or widely in their financial reporting, compared to 33%. Approximately 3 in 5, or 59% of Canadian corporates, are allocating more than 10% of their IT budgets to AI, compared to less than half of their global peers. Ben, I think you're the right person I'm addressing this question to, because you covered this story for CTMfile and also because you understand AI well. From a Canadian corporate perspective, do you think that the hurry to implement AI in financial reporting will give them an edge over corporations from other countries? Or do you think it is better that they progress slowly, accounting for regulatory compliance changes, data security, and privacy risks?
That's a great question, because there's obviously two different routes you could go there. Do you want to try and get a first mover advantage, but potentially be caught out by unexpected roadblocks or issues along the way, or go slowly and kind of follow the tortoise and the hare analogy? I think it is interesting that obviously they are outmatching what's happening globally in terms of piloting and investigating AI, but a much lower percentage who have already implemented it. So I think that shows a bit of maybe traditional Canadian cautiousness there. I think that's probably quite a good way to go. You want to make sure that when you do go live with AI, First of all, it's already fed with a lot of data before you even go live and start exposing it to new real-time data that's coming on. You can't just launch basically empty. You need to have your data strategy in place and have that data flowing well before you go live with an AI tool like that. Using AI, it's got a lot of obvious perks, but companies do need to be careful about how they manage it, particularly, we're talking about reporting in this story. I think there should probably be a focus on making sure that you're creating the rules and systems around it that are driven by values, they're centered around people, and that trust has to be there to help that switch to AI be a safe switch and for it to progress smoothly. So businesses should put money into AI technology, but you also need to train the team. You need to get everyone up to speed and understanding how AI benefits what they do in their role, so that specifically in this example, they're ready for AI-driven financial reporting.
Well, that's a thoughtful observation, and I couldn't agree with you more. Finally, Ben, what is your choice for the biggest or most important story of the past week, and why?
So I've gone back to the interest rate cut speculation well for my top story this week, this time looking at the UK, where the Bank of England has given its strongest hint yet that interest rates could be cut this summer. Bank Deputy Governor Ben Broadbent said in a speech this week that a rate cut at some time over the summer was possible. That's what's got us excited here. His comments come ahead of figures that are coming out tomorrow, Wednesday the 22nd of May, as we're speaking, that are expected to show quite a sharp drop in inflation in the UK, which obviously is one of the key things that the bank has been trying to achieve with higher rates, and as other central banks all around the world have been. Now, Broadbent is one of the 9 voters on the bank's Monetary Policy Committee that decides interest rates. So earlier this month, there was a vote that was 7-2 to maintain. 2 members of the panel voted to cut, but obviously the rates were maintained at 5.25%, and Broadbent himself voted with the majority to keep borrowing costs at the current 16-year high. Also worth maybe noting that next month's meeting of the Bank of England Monetary Policy Committee is his last before he leaves the bank in July, so maybe he's got a little bit more leeway to be a bit more confident talking about it. And in fact, today we heard from the International Monetary Fund a recommendation that UK interest rates should be cut to 3.5% by the end of next year. So that would see, the Bank of England have to cut its key rate by up to 7 times from its current level in the next, 19 months. So interesting times ahead. Rate cuts are coming, but we're just playing the waiting game. Who's going to cut first and who's going to cut the hardest? But it seems like there could be some movement in the UK this summer.
So who do you think is going to cut first and the hardest, Ben?
If I answer that, I will immediately be proved incorrect. So I think for a long time we were maybe thinking it could be the Fed. I think maybe the ECB actually is just kind of poked its nose out ahead at the moment. But we'll see. I mean, if the UK goes in July, all bets are off.
Well, that's $1 million guess, and you're right. It's difficult to hazard a guess on interest rates, particularly, in the Western world. I agree. We've reached the end of this episode. Many thanks to you, Ben, for your valuable and informative analysis. We would also like to express our deep gratitude to our CTMfile audience for joining us on this edition of the Open Treasury podcast. Please subscribe and look in the show notes for the article links. Thank you and have a wonderful week. This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.